London is looking like a very interesting place for property investment right now, and in this video I'm going to share with you 5 strategies which are going to work a treat if you're serious about investing in property in London. Hi, my name's Ranjan Bhattacharya. I've been investing and developing properties for the last 30 years. I've also coached and mentored hundreds of people transform their lives through real estate investing. This is my channel. If you're new here, make sure you subscribe and smash that bell icon. We put out new content each and every week, and it's all dedicated to helping you be more successful in property. Also please like the video, it helps us out on YouTube, and comment, tell me what you think about my views here. Now, a lot's changed in the property market, and I'm a firm believer that 2020, 2021 is going to be an ideal time to think about investing right here in the capital, right here in London. Now, a lot of people think I'm a little bit London-centric. I mean, when people ask me about what do you think about investing up north, I reply to them, Edgware or Cockfosters. But seriously, guys, we all know that London is a little bit separate from the rest of the UK because London is a world city in the same way that, say, Bolton or Hull just aren't. When I go to a hotel around the world and you arrive at reception and you see those clocks above the reception desk, you see London, Rome, Paris, Tokyo. You don't see Hull. So London is our global city that we have in the UK, and it really sits apart from the rest of the UK, and it also sits apart in terms of attracting investors both from the UK and internationally. Now, investing in London has been quite challenging in recent years, mainly because stamp duty has been too high. First of all, to get anything decent is quite challenging, below £500,000, and then the stamp duty rates ratchet up above that. Plus, you've had the 3% additional surcharge too. But now, of course, Rishi Sunak's change in the recent budget has meant that stamp duty has just got a lot cheaper in London, although not obliterated altogether. Basically right now, and I've done a video on stamp duty and the changes and how it affects property investors, but to put it in a nutshell, if you buy something for under £500,000, you pay as an investor a flat 3% stamp duty rate. Now, a lot of people, particularly recent investors, moan and say, well, that's not very good, isn't it? I'm still paying 3%. Well, I've been investing in this property for more than 30 years, and I look at things slightly differently. The way I look at it is 3% stamp duty on transactions under £500,000 was the level of stamp duty I was paying back in 2001. And back then, with that level of stamp duty rate, a whole bunch of strategies were viable, which in recent years became unviable, but I believe come back into play. Now, being successful investing in London is really all about timing and understanding the ebbs and flows in the way that the London market works. The London market goes through its doldrums, and it will be going through a little bit of doldrums for a couple of years or so, particularly with all the uncertainty that we've got and employment and all the rest of it, which I've talked about in other videos. But over the next few years, prices will not go up. There will be some properties in London which will be challenged and may go down, and these will typically be areas where there's been a huge amount of new build flats come onto the market in a hurry. Often these are sold off plan, and often these have been selling at a little bit of a premium. So we will see a little bit of a comeback on some of those, I would say, overpriced developer sold new build apartments. But what we tend to find is that second-hand housing in well-established, solid areas, they don't go down, but then they don't go up. We just have a few years of not too much happening. And if you look at the graphs of how London behaves, that tends to characterize what happens. You go through a few years of not much happening at all, and those are ideal buying opportunities. Because when London grows, it tends to grow by double-digit growth every year in bursts of a few years. And one thing is certain, when London is in the doldrums and you don't get much growth for a few years, that is followed by catch-up time. That's followed by a few successive years where you get double-digit growth each and every year. And that's where you make your returns in London. by timing your entry into the market when it's in the doldrums, and riding it out through those boom years of double-digit growth. Now, I've put a link to a video of how I believe property prices are going to behave, and I think that's going to pan out. And what I said in that video is basically we're going to be challenged with employment figures over the next few years until that returns to normal, until our economy gets to pre-COVID levels. Then the prices in the capital will remain subdued. So we're going to be a few years in the doldrums. It'll all recover once our economy bounces back to pre-COVID levels, but that will take a few years. But when it does recover, it will recover big time. Why? Because during this COVID-19 crisis, they've pumped billions into the economy, a lot more than they did in the credit crunch crash in the aftermath of 2009. And what that means is that sooner or later, when you inject so much money into the economy, it leads to asset price inflation. And asset price inflation happens most where the assets are in finite supply, and that tends to be in the capital. We've also got some geopolitical factors creeping in. All the problems in Hong Kong has meant that 200,000 people with UK passports will be given the right to live, work and set up businesses in the UK from Hong Kong. We don't know how many of those 200,000 will take up that offer, but what we do know is that London, the capital city, has a big draw with people coming from abroad. So let's look at 5 strategies which will work a treat in London and how best to play them. Strategy number 1 is simple fixer-uppers for either flipping or refinancing. One of the things that happens when the market is the way it is today is that you see more of a price differential open up between A1 property in A1 condition and shabby property which is in need of a lot of modernisation or is slightly distressed. You also see more properties being offered for sale by sellers who are motivated to actually sell the property over and above getting the best price for the property. When you can combine getting a distressed property from a motivated seller, you've got yourself a bargain. Now, with the recent stamp duty changes, particularly for properties under £500,000, where you're only paying a flat 3% as an investor, it is now viable again to buy these properties as fixer-upper opportunities to then make them into A1 condition and either flip them on in the market or refinance and keep. Now, the reason I've always loved and favoured this fixer-upper strategy in London as opposed to anywhere else in the country is because it's a high-value area. It's because price per square foot is more than in any other part of the country. Well, what does that mean? Well, if you're spending £400,000 and you're purchasing a one-bedroom flat, which might be just 40 square metres in size, then every square metre of that property is worth a significant amount of money. If you're buying a £400,000 property up north, then you're typically buying a whole house. And if you're buying a whole house, it'll take longer to actually refurbish that property. Because if you're buying a £400,000 property in London, you're typically buying a one-bedroom flat. And you've just got a small space to focus your refurbing budget, time and energies on. When you've got a whole house, you've got to think about doing up the garden, the front gate, the roof, the gutter, the whole house. And that refurb takes more time and it can cost more money. In times like this, the fixer-upper strategy works best if you're in and out of deals quickly. And if you're in and out of higher priced deals quickly, you can do more deal turnover because the refurbishing a one-bedroom flat is a lot simpler than doing a 3-bedroom house. And because the values are higher, you're typically making more on those sort of simpler refurbishments, but turning over your money far quicker. Strategy 2 is to take small houses and flats and to make simple layout changes. So this is all simple textbook stuff, really. I mean, and it also is based on this strange concept we have in the UK, where a lot of property is valued based on the number of bedrooms it has. We tend to value 2-bedroom places as being more expensive than 1-bedroom places, but internationally people tend to value it based on a square foot. So that's one aspect. The second aspect is that the way people made flats and houses, say 20 years ago, 30 years ago, are quite different to the way they lay them out today. So this strategy works best if you find a larger than average but poorly laid out one-bedroom flat. And by simple layout changes, you can make it into a two-bedroom flat. Now this works best when a flat has, say, a separate kitchen. So if you've got a separate kitchen, a large lounge and a one-bedroom flat, then with a simple bit of reconfiguration, you can make an open plan kitchen lounge and convert the old kitchen into a bedroom. And this works a treat for making one-bedroom premises into two bedrooms, two-bedroom premises into three bedrooms, and so forth. And it works even better if you are looking to retain those properties as part of a rental portfolio, because obviously adding more bedrooms adds more rental value, which means that you can pull more out of the transaction once you've refurbished the property and remortgaged it to keep in your portfolio. And these are great properties to do. Basically, buy, change the layout, increase the bedroom count, get them refinanced, put them in your portfolio and hold for the uptick that will happen within a 5-year period. Strategy number 3 is if you're looking at flats, which many people will be doing in London, look in particular for share of freehold flats over leasehold flats. Now, leasehold flats can be expensive, particularly in London. And that's because of service charges. Now, the exact difference between leasehold and share freehold properties is really a subject for another video, and make sure you subscribe and all of that and hit the bell icon, and I'll do that for you a little bit later on. But the big issue with leasehold flats is the service charge, and service charges are expensive in London. With all flats, you have to pay a service charge to the freeholder so that they can maintain the communal parts of the building and also keep the building external structure and all that sort of stuff up to a certain standard. Now, of course, the freeholder normally gets a property manager in to manage that building and manage repairs and maintenance to that whole block of flats, for which, of course, there is a management charge. When you buy something which is a share of the freehold, you basically buy the leasehold flat, but you also buy a share in the company that owns the freehold, and basically all the leaseholders in the block collectively own the freehold and are collectively responsible for maintaining the block. When you buy a share freehold flat, what you tend to find is that the service charges are much, much lower than when there's an external freeholder. Why? Because all the flat owners collectively kind of look after the building and make the decisions on what contractors to employ and so forth. Over the years, we've picked up quite a few share freehold flats, and roughly speaking, I would say the service charges are sometimes half of what you'd find if there's an external freeholder involved. The other great benefit is there's no ticking time bomb of the lease. When you buy a leasehold flat, originally the lease may be for 125 years, and that lease eventually ticks down year by year by year. And when that lease gets below 70 years or so, it becomes very hard to sell or refinance, and then you have to go cap in hand to the freeholder and pay them to extend the lease out so that it's saleable and mortgageable. When you have a share freehold flat, because you are also the freeholder, you don't have that issue. Now, there's also another stonking benefit from share of freehold flats, which is really coming to fruition right now. Now, as I mentioned, we've bought quite a few of these share freehold flats over the years, and many of these are in purpose-built blocks. And people will be aware of the recent changes to planning permission, where now under permitted development you can build extra floors above purpose-built blocks. Now, if you're in a leasehold flat and you don't own a share of the freehold, the benefit of building additional floors on a building will be for the freeholder. But if you own a share of that freehold, you also will have part share in the benefit of building additional floors on the top of your block. For this reason, buying share freehold flats in purpose-built blocks might be a great way of getting a toehold into the opportunity of building additional floors above blocks of flats. Now, strategy 4 is about freehold houses. I've talked a lot about flats because really, if you're spending under £500,000 in London, a lot of the properties are flats. But what do I mean by London? By London, I'm meaning a relatively broad definition as being within the M25. Now, within the M25, it is actually quite hard to buy a house, a freehold house, for under £350,000. There are some areas still. I mean, just go on a Rightmove, put the postcode on as the centre of London, pick a 20-mile radius and see for yourself. You will see that there are places within the M25 where you can still buy a freehold house for under £350,000. Here's my prediction, and you can replay this video in 5 years' time. Within 5 years, to buy a freehold house for under £350,000 within the M25 will be impossible. Those sort of properties will be extinct. I think now is a terrific time to pick up on these well-located freehold houses that are still left. Now, if you are buying houses, if you've got the choice, try to pick ones which are semi-detached or end-of-terraced as opposed to mid-terraced, because there are more options for extending the floor space with those sort of properties than with mid-terraced properties. And of course, if you are looking to extend the property, houses come with permitted development rights, which flats do not. So there's plenty of opportunity for changing the layout, adding a little bit of space, and developing houses within the M25. And strategy 5, I'm saving the best till last really. It's commercial to residential conversion, and in particular converting shops, former retail premises, into residential use. Within the M25 we have far too many shops than we actually need. We have far too many secondary parades. If we rewind, say, 100 years, London comprised of a whole bunch of small towns and villages. And really, after about 1930 onwards, all these towns and villages just seem to merge into one mass. And it's quite hard to actually define where one town and village actually ends and another one starts. So what's happened is London has basically sprawled out, and it's connected by a whole bunch of secondary parades of retail shops. Now, there's always going to be a demand for shops. Wherever there's people will need shops. But it's what those shops are doing that's changing dramatically. We need to get stuff done, usually to ourselves, whether it's our hair, our makeup, our nails, or whatever it is that you need doing. We need services like cups of coffee and stuff like that, and food and eating out. These are all things that you can't do over the internet. You can't get delivered in a van. These sort of things will continue to be provisioned in retail premises. But we do not need anything like the number of premises that we have right now. We already have on the table permitted development rights, which allow us to partially or fully convert these premises into residential units without having to go through the vagaries of planning permission. And it's already great news as I do this video, but coming in the next couple of months are even more rights to make it even simpler than it already is to repurpose some of these buildings. Particularly in the outskirts of London, there are plenty of these commercial premises that can be picked up for £250, £260 a square foot. You spend about £100 a square foot converting them, and you end up with a £200 per square foot uplift, simply because the value of residential space is far more than the value of vacant commercial space. I'll put a link to this video here of a before and after case study of one of my students who converted a shop in West Ealing into a smaller shop and a one-bedroom flat at the back, which actually produced £200,000. So to summarise, London is going to be ripe for investment opportunity, particularly as we're entering a few years where the prices are going to be in the doldrums. By being in the doldrums, I mean just stay pretty much flat. That's going to present plenty of opportunity to find distressed properties of motivated sellers. Use the stamp duty benefit that you've got by having a flat rate of 3% on property purchase under £500,000 to find value and add value. And the best game in town for adding that value is going to be converting unused or unrequired commercial spaces into residential uses, be them small offices or former retail premises. Now, this is an area that I do quite a lot of, and I run some very specialist training on the subject. I run a weekend workshop that takes you through the A to Z of how to repurpose commercial buildings into residential uses, how to actually do commercial property buy-to-let, and how to deploy your pension funds to make work for you in commercial property repurposing. To find out more about exactly what's involved and exactly what's covered in this extensive training, you can click on the link below, succeedinproperty.com/workshop for full details. But I'll see you guys in the next video.